students, welcome to the lecture on branch accounts, and after the lecture we will be able to learn the following objectives. Explain the dependent branch, describe the stock and debtors method, define the debtor system, explain the final account system, discuss about the independent branch, explain the foreign branches. Let's start with a brief introduction to branch accounts. The large manufacturing and trading concerns operate at different places in the same country as well as in foreign countries through their own establishments for promoting sales and eliminating middlemen. The system of operating at several places through one's own establishments is called branch organization. The parent or the main establishment located at the main place of the activity and which exercises control over the other establishments is called the head office, and the subsidiary establishments located at various places are called the branches. Branch accounting is the practice of handling one's company's financial information by using several independent accounting offices. The independent offices handle the reporting, recording, and managing of a company. The accounting systems are all independent of each other and separate. The home office typically has an account with the general accounting ledger that shows information from all branches. Branch accounting often has an accounting manager or a supervisor who is responsible for updating all of the information. An accounting system in which separate accounts are maintained for each branch of a corporate entity or organization. The primary objectives of branch accounting are better accountability and control, since profitability and efficiency can be closely tracked at the branch level. Organizations that have branches in multiple locations may encounter difficulties in optimizing operational efficiencies and control within their various branches. The accounting departments of these organizations understand the difficulty of maintaining correct and up-to-date financial information for the different branches. Branch accounting is a new bidirectional synchronization tool that delivers all the benefits of working locally at branch level and also ensures that all financial information is automatically synchronized to head office. The branch accounting solution encrypts data using key identifiers to secure confidential data from being shared or duplicated across the branch accounting environment. This allows head office to have full control over the affiliated branches but restricts branches to global and branch-specific information. The solution offers consistency within the branch accounting environment by implementing the preferred account, structures, numbering structures, accounting periods, and standard operating procedures. There are centralized and decentralized accounting scenarios. Centralized. In a centralized scenario, the head office and affiliated branches will log into the head office database via a terminal server or another means of direct access. Branches are able to transact in their own capacity and are limited to their financial data, with the branch data being immediately updated at head office level. Decentralized. A decentralized scenario allows branches to transact independently within their own database and is able to generate operating and management reports at branch level. Thereafter, data is synchronized by means of an FTP server to head office level, where branch-specific and/or consolidated reports can be generated. Objectives of branch accounting. The main objectives of keeping branch accounts are to know the final result, that is, the profit or loss of each branch separately, to ascertain the real financial position of each branch, to exercise proper control over each branch, to ascertain and to meet the goods and cash requirements of each branch, to meet the requirements of special acts. Let us now talk about dependent branch. Dependent branches are the branches that do not keep their records, but all the records are maintained by head office. They are not authorized to act solely without the prior permission of the head office. All the plans, policies, rules and regulations of these branches are totally formulated and executed by the head office. In other words, all the functions of dependent branch are totally controlled by head office. Under dependent branch, two types of branches are included, which is termed as service branch and retail branch. When the business policies and the administration of a branch are wholly controlled by the head office and its accounts also are maintained by it, the branch is described as dependent branch. Branch accounts in such a case are maintained at the head office out of reports and returns received from the branch. Some of the significant types of branches that are operated in these manners are a branch setup merely for booking orders that are executed by the head office. Such a branch only transmits orders to the head office. A branch established at a commercial center for the sale of goods, wholesale, supplied by the head office, and under its direction all collections are made by the HO. A branch for the retail sale of goods supplied by the head office. Accounting in the case of first two types is simple. Only a record of expenses incurred at the branch has to be maintained. But however, a retail branch is essentially a sale agency that principally sells goods supplied by the head office for cash and, if so authorized, also on credit to approved customers. Methods of charging goods to branches. Goods may be invoiced to branches at cost, at selling price, in case of retail branches at wholesale price. Selling price method is adopted where the goods would be sold at a fixed price by the branch. It is suitable for dealers in tea, petrol, etc. In this way, greater control can be exercised over the working of a branch, inasmuch as that the branch balance in the head office books would always be composed of the value of unsold stock at the branch and remittance of goods in transit. The arbitrary price method is usually adopted if the selling price is not known or when it is not considered desirable to disclose to the branch manager the profit made by the branch. Accounting for dependent branches. Dependent branch does not maintain a complete record of its transactions. When goods are invoiced at cost, if goods are invoiced to the branch at cost, the trading result of branch can be ascertained by following any of the three methods: debtors method, stock and debtors method, trading and profit and loss account, final accounts method. For finding out the trading results of branch, it is assumed that the branch is an entity separate from the head office. On the basis, a branch account is started in the head office books to which the price of goods or services provided or expenses paid out are debited, and correspondingly the values of benefits and cash received from the branch are credited. Let us now study debtors method. This method of accounting is suitable for small-sized branches. Under this method, a separate branch account is maintained for each branch to compute a profit or loss made by each branch. The opening balance of stock, debtors, if any, petty cash, if any, are debited to the branch account. The cost of goods sent to branch as well as expenses of the branch paid by the head office, example salaries, rent, insurance, etc., are also debited to it. Conversely, amounts remitted by the branch and the cost of goods returned by the branch are credited. At the end of the year, the value of unsold stock, the total of customer balances outstanding, and that of petty cash are brought into the branch account on the credit side, and then the branch account will reveal profit or loss. Debit balance will be the loss suffered by the working of the branch, and vice versa. If the branch is allowed to make small purchases of goods locally as well as incur expenses out of its cash receipts, it will be necessary for the branch to supply to the head office a copy of the cash account showing details of cash collections, disbursements. The head office can also ascertain the profit or loss of a dependent branch by preparing branch trading and profit and loss of a dependent branch by preparing branch trading and profit and loss account at cost. In this method, trading and profit and loss accounts are prepared considering each branch as a separate entity. The main advantage of this method is that it is easy to prepare and understand. It also gives complete information of all transactions which are ignored in the other methods. It should be noted that branch trading and profit and loss account is merely a memorandum account, and therefore the entries made therein do not have double entry effect. All items of memorandum branch trading and profit and loss account are to be converted into cost price if the goods are invoiced to branch at selling price.
Before I start final accounts, you must be aware about the format and items of the final accounts. Final accounts have got three parts: trading account, profit and loss account, and balance sheet. Let's talk about trading account. Whenever you write trading account, you should write down trading account for the year ending 31st March 2013. Because in this question, I'm going to take 31st March 2013 as my closing date. So it's always prepared in the T shape. Not always, basically there are different presentation of making trading account, but we will make only and only in T shape. So when you create the T, you will get the two portion, left hand side and right hand side. On left hand side the column will be particulars then amount, and on right hand side particulars and amount. On debit side, first of all at the top corner you should write opening stock, because in this trading account the closing date is 31st March 2013. So opening stock means stock as on 1st April 2012. That will be our opening stock, and then the next item will be two purchases, and then the next item will be two direct expenses. And on credit side at the top please write down by sales and then by closing stock. Closing stock means the stock as on 31st March 2013. So in this way, normally you will find that credit side of the trading account will be stronger than debit side. It's not the rule, but generally you will find it. And the gap, the balancing figures supplied on the debit side will be called to gross profit. So it's just like you can say it's a sort of ledger. You have to supply one particular amount to the weaker side and you have to make the totals equal, just like you did it in ledger posting. So that will be called our gross profit. Then number 2, profit and loss count. Profit and loss count for the year ended 31st March 2013. The format of the profit and loss count will be same as we did it in trading account. Means it will be in T shape. The gross profit you have found on the debit side of trading account, it will be transferred to the credit side of profit and loss count by gross profit, whatever you have got it from trading account. It means profit and loss count cannot be prepared without making trading account, because trading account will give us gross profit and gross profit will be transferred to profit and loss count. And on the debit side you will write down two indirect expenses, and on credit side you will write down by incomes. So I'm going to assume that the total of the credit side is stronger than the debit side. So on debit side you will have to supply one more figure which is called balancing figure, so that the totals on both sides is equal. That will be your net profit. So in this way you can find out the net profit through profit and loss count. In our previous segments we used to find the net profit through the formula, that was closing capital minus opening capital plus drawings minus fresh capital. So but now we are going to find the profit through profit and loss account, and after that balance sheet is prepared. And what will be the format of balance sheet? On liability side, first of all write down capital. The amount of capital should be in the inner column, then add net profit, and whatever you get the total, it will be taken to the outer column of balance sheet in the amount column. And otherwise you know each and everything about the balance sheet. You have already learnt about it.
We shall now look at the independent branch. The branches that can keep their accounts to themselves and sell goods that are sent by the head office, as well as those purchased by them, are known as independent branches. These are the branches which can sell the goods to head office too. They can pay their own expenses and can deposit their collections in their own name in the bank. These branches record separately and independently all the transactions which are even recorded by the head office. When the size of the business is big, it is desirable that the branch maintains complete records of its transactions. These branches are called independent branches, and each independent branch maintains comprehensive account books for recording their transactions. Therefore, a separate trial balance of each branch can be prepared. The head office maintains one ledger account for each such branch, wherein all transactions between the head office and the branches are recorded. Salient features of accounting system of an independent branch are: branch maintains its entire books of accounts under double entry system. Branch opens in its books a head office account to record all transactions that take place between head office and branch. The head office maintains a branch account to record those transactions. Branch prepares its trial balance, trading and profit and loss account at the end of the accounting period and sends copies of these statements to head office for incorporation. After receiving the final statements from branch, head office reconciles between the two branch account in head office and head office account in branch books. Head offices passes necessary journals to incorporate branch trial balance in its books. The final result of these adjustments will be that so far as the head office is concerned, the branch will be looked upon either as a debtor or creditor, as a debtor if the amount of its assets is in excess of its liabilities, and as a creditor if the position is reversed. A debit balance in the branch account should always be equal to the net assets at the branch. The important thing to remember when independent sets of accounts are maintained is that the branch and head office books are connected with each other only through the medium of the branch and the head office account, which are converse of each other, and also when accounts of the branch and head offices are consolidated, both the branch and head offices accounts will be eliminated. Foreign branches. Foreign branches generally maintain independent and complete record of business transacted by them in currency of the country in which they operate. Thus, problems of incorporating balances of foreign branches relate mainly to translation of foreign currency. This is because exchange rate of Indian rupee is not stable in relation to foreign currencies due to its international demand and supply effects on various currencies. The accounting principles which apply to inland branches also apply to a foreign branch after converting the trial balance of the foreign branch. Accounting for foreign branches. For the purpose of accounting, classifies the foreign branches may be classified into two types: integral foreign operation, non-integral foreign operation. Integral foreign operation, or IFO, it is a foreign operation the activities of which are an integral part of those of the reporting
we need to look at foreign currency translations. These are much simpler to deal with. Effectively, what you are doing is taking the statement of comprehensive income and statement of financial position of, say, an overseas subsidiary, and converting all the line items into the presentation currency of the group. Assets and liabilities are translated using the closing rate at the date of that statement of financial position. Income and expenses are translated using the exchange rates at the date of the transactions. Equity is, well, it isn't really discussed, but what we're going to do is look at how it generally gets dealt with in the example that we look at. What we have here is a simplified statement of comprehensive income, as well as information about the exchange rate at the start and at the end of the period, as well as the average rate. The first thing to do is to determine which exchange rate you use for which item. Now we ignore the totals here, so net profit before tax, net profit after tax, retained earnings close. In this case, the average rate gets used for sales revenue, expenses, and tax expensed. Whilst arguably you could identify the actual exchange rate for each individual sale and expense, realistically it's not that practical, and paragraph 40 allows you to use average rates. Retained earnings is an equity item and would generally use the open rate for the period. The second thing to do is to calculate the Aussie dollar amounts for each of these items and then total them. So sales revenue of 2,850 becomes 2,775 in Australian, and expenses of 2,540 in US becomes 2,473 in Australian. This leaves a net profit before tax of 302. Now this is important. The 302 is calculated based on the translated amounts. It isn't translated itself. This makes sense when we get to retained earnings close because it's comprised of line items using different translation rates. Sales, expenses, and tax expense use the average rate, whilst retained earnings open uses the opening rate. For the statement of financial position, assets and liabilities use the closing rate. For equities, in a sense it doesn't matter because assets and liabilities are already defined using the closing rate, and as such the total amount of equity is also defined, and this is just the accounting equation at work. But we still have line items to deal with. The general convention here is that share capital is converted using the opening rate, whilst retained earnings is taken from the translated statement of comprehensive income. When we put all these rates in and translate them, we're left with a problem. This problem is that the sum of the translated liabilities and equities does not equal the sum of the translated assets. Now, accountants love a balance sheet to balance, even though we don't call it a balance sheet anymore. So paragraph 39C requires that all other exchange rate differences be recognized in OCI, which is why we have a foreign currency translation reserve of 172. This is simply the balancing item.